Ladies and gentlemen, an article just came out and it compares Temasek and GIC's performance to global sovereign wealth fund and highlight that we are performing subpar to these benchmarks. And I think this is an area of concern. And there's a lot of lessons for us as private investors as well. So let's just watch on and see what the insights are. So the article from Financial Times highlight that our Singapore giants, particularly I think referring to Temasek and GIC, falling behind, and this is of course an area of concern to all Singaporeans and also a topic of concern and topic of interest to me as a investor. So this article came out on 5th of December on Financial Times. It was reposted by Bertha Henson on Facebook and it caught my eye then because I don't subscribe to Financial Times. And it basically says that are Singapore giants fallen behind. So this is a very long article. So I'll probably give you a flavor of it and reproduce some of the slides to let you know what's the highlight of this article. So this article does matter because it brings out to an open that Temasek and GIC, which has been powering up Singapore long-term fiscal strength through strategic global investment, has been producing subpar results compared to the global sovereign wealth funds. And their returns of these two entities directly influence our net investment return contribution, which is an important part of our Singapore budget. So the more they could produce, the more the Singapore government would have more to spend and possibly give us more subsidy or vouchers or whatever, or at least tax less, right? So I think the results of these two entities are important since it's come out in the public. So I think it's probably worthwhile to talk about it. So let's just watch on what they say. So basically, they are alluding the fact that we have underperformed at a decade level. So both funds have underperformed the other benchmarks over the last 10 years. The returns are described as modest and uncompetitive versus a global market benchmarks, in particular other sovereign wealth fund. And there are concerns raised about risk management and capital allocation, methodology, discipline, and strategic decisions that were made. And I think it's worthwhile to take a look at this. So they highlight a couple of important points and history. For example, in Temasek, they highlight that FTX was one that there was a huge write-off. So Temasek has some high-profile missteps and losses. So we highlight a pretty big loss of FTX, and they highlight it as a symbol of deeper systemic issue, not merely just an isolated incident. Now, they also say that Temasek has an heavy tilt in earlier days towards early stage ventures that cause a lot of volatility and uneven compounding. Now, this one I can attest to it in the sense that I've always felt myself as a good early stage investor in the startup space as well. But so far, all the investment that I make on the early stage, wow, it's a very difficult journey. So since I came to realize that this is a very tough field, even if I know the founder, even if I know the business, you know, I I don't think we can create unfair gains simply because of that. So I felt that this is not a business that I should be in, and I've stepped away from it. I think Temasek also realized that in a big way as well. So all has stepped away from it. So the returns over the last decade or so, it's about 5%, 5% annually, compound annual growth rate. That's far below the market double-digit performance so far. If you put your money in the S&P 500 or even Nasdaq, we're looking at, I think, 10 to 12% easily, or even 12 to 15% if you look at the Nasdaq over the last 5 years or so, or even the 10 years. So it's a lot of shortfall relative to global benchmark. And if you even take a look at the more milder one like MSCI World Index, I think easily they will produce about 7 to 8%. So produce 5%, I think it's a big shortfall. And that's why I think Financial Times actually highlighted it. And now, so to be fair, Temasek have actually pivoted away from early stage investment, and this is a retreat after aggressive risk taking. Okay, and I think at least you have already learned this as this not probably your cup of tea and venture away from it. Better do it early than later. So in terms of Temasek response to all this shortfall, I think they actually done some major restructuring. Now they split into three units to sharpen focus and accountability and improve on financial discipline and oversight, reduce internal complexity and basically put more focus and accountability. So this is a response probably to either market changes or performance driven. So I think there's some response on Temasek side. On GIC side, it's more maybe a position of too conservative, according to Financial Times, that they have been prioritizing more capital preservation and miss a lot of growth opportunity. So GIC has taken a too conservative position. As a result, they missed, and by the way, that includes Temasek as well. They missed a decade-long bull run, right? That myself have enjoyed, many of you have enjoyed, and the returns are around 5%, trailing even its own reference portfolio of global equities and bonds. So the question really from Financial Times is whether GIC mandate is too defensive for today's market. Now, this is a chart that is in the article. I've reproduced it. So if you take a look at the Sweden fund over the last 10 years, okay, 2015 to now, it's about 12.5%. The New Zealand one is about 10%. These are all sovereign wealth fund. Canadian one is about, my guess, eyeballing it about 9%. Australian one, 8%. Norwegian one is about maybe 7%. Abu Dhabi, probably 7%. China Investment Corporation is probably 6+%. And Saudi Arabia one, just slightly above 6.5% or so. But we rank 5 or below 5. And we are only above Chile. I expected more, right? Yeah, I expected more. I think all of us expected more, and these are quite quite concerning, right? In terms of the underperformance relative to other sovereign wealth fund, and I think this is something that surprised me actually. So their underperformance has quite a lot of implications to Singapore budget because their contribution to our Singapore budget really helps in pushing and funding our government's expenditure and growth. Now, all said and done, it's very easy to criticize, right? It's I don't know if you have this habit before, but when you're driving and someone criticizing you from the side, you should be doing this, why you're not doing that accounting. So I suppose that I've never managed funds more than a few $1 million, so it's easy to criticize on the side, right? But the truth I know for a fact, beating market is really very difficult. To outdo market is really very difficult. So if you were to take a look at the S&P 500 over the last decade, it's about 10.5% or so, depending how you look at it. MSCI World Index, 8.5% or more. For GIC to do 5, I'm sure they already benchmark themselves to some of this market and say, wow, I think we are subpar. Okay, maybe there are strategic consideration like they have to participate in this market. Even for example, China, but I think recently they also pare down their Chinese investment and so on. So I think it's probably easy for people like us to criticize, but I think that maybe driving a big lorry is a lot more difficult than driving a small little car that I have. So I think it's a tough job, okay? But that said, maybe one of the strategy they could adopt is just, participate in the whole market, right? That's a lot easier. So let me further emphasize again that maybe to participate in the whole market, if you participate in the whole market, whether you as a private investor or big sovereign wealth fund or big funds, you would have ridden on this big bull run on the tech and this big bull run on AI and things like that. So if you basically don't participate in global markets, you just miss out on a lot of compounding. Now, I'm not qualified to criticize how big funds should run. I've never run one before, but I know there are some lessons here for retail investors. This part I think I'm qualified to say. Stop pretending that you can beat the market. Right? A lot of y'all like to buy individual stocks and like to punt, buy, sell, pick individual stocks and things like that. I'll just say this, if even world-class institutions like Temasek and GIC struggle to beat the market, what about small investors like you and me, right? You can say, oh, I'm better than GIC and Temasek whatsoever. Okay, maybe so. But if you look at all the other sovereign wealth fund, if you take a look at all their sovereign wealth fund, I don't think they do a lot better than most of them don't do as well as the market, right? If you take a look at this, okay, that's where the S&P 500 is, right? Almost everyone under fall short of it, right? And that's why I'm a big supporter of just throwing money into S&P 500 and maybe in some other funds. Okay, so all said and done, I think that just betting on the whole market is a lot easier for retail investors like us. I will just say this again, and this is not telling Temasek and GIC you should do that, but for private investors such as myself, okay, this is what I do, and I say it before and I say it again, right? So I form a financial safety net with the CPF, GIC, and Temasek can't do that because they are corporations. But I do a financial safety net with my CPF and make it really, really strong. And from there, I layer on S&P 500 or global diversified portfolios. And I then take a two-third, one-third ratio and put into NASDAQ, which is a lot more volatile, but a lot more growth. And some exposure to bonds as well. That's all I do, okay? And bet on the market when the market crash, right? Some of you all who attended my course will know that I make about 15% growth a year. That's good enough, right? It's 15%, man. I don't think I can ever be as good as Warren Buffett or so. But 15% is like, wow, insane. I can survive with 10. Yeah, 15% is beyond my personal expectation. So I would just say this that you know time in the market is important. Timing the market, I do only in the beginning. That means when I time the market at the entry and then forget it. So I never buy, sell, just write it on. And a broad-based diversification is important. And that's all I do, right? As simple as that. That's all I do. So let me say this again, right to your face and right to everybody's face. If experts cannot beat the market, I think 99.999% of y'all can't. Okay? So don't pretend that y'all can beat the market. So stock picking is very difficult. Stock picking is really very difficult. Just invest in globally diversified portfolios, okay? And just hold long term. As you rise up, as you come down, do periodic rebalancing. That's all you do, right? And you can live well, sleep well, and the market will grow phenomenally. You have millions of dollars at retirement, right? So that's all you need to do. And I don't think that we can do much better than that as a retail investor. As for as for Temasek and GIC, I think they are already self-aware of this situation. I don't think that business as usual is acceptable to them. So I really see that they are doing some restructuring and things like that. Let's hope that they will get their act better next time for the next few years to come and do better on their investment. We wish them well because once they do well, we also do well as citizens of Singapore. Thank you for watching. Happy to hear your comments. Bye bye.